Good afternoon, everyone, and welcome to the Monday Open, hosted by Vantage Australia's private client group. My name is Ollie, and today I'm joined here by Tony. Tony, how you doing?
Good. How about you, Ollie?
I'm doing very well, thank you, mate.
Excellent.
So, okay. So, moving into the schedule for today, it'll be pretty familiar for anyone who's watched it before, but just to go over it with everyone, we typically start off with a summary of last week and an overview of any upcoming major events. We then switch over to the technical corner where we go over a couple different markets and identify potential opportunities through a top-down analysis. We then shoot it over to the Q&A where we answer some of the common questions we get asked by clients. So without further ado, let's jump into it. Tony, would you like to take it away with a summary of last week?
Not a problem. Thank you very much. All right. So we have a lot of information coming from US last week. Begin with Tuesday. US Consumer Price Index (CPI) for the April 2025 rose 2.3% year over year, slightly below the expected 2.4%. So what does that mean for the traders? The softer CPI data suggests easing of the inflationary pressures, potentially giving the Federal Reserve more room to maintain the current interest rates or consider rate cuts later in 2025. Now, this could be a good news for the equity market. Furthermore, a potential higher chance of a rate cut weakens the US dollars, hence could potentially causing the gold price to be further supported. Now, as a result, we're seeing immediate reaction from the market. It was a positive. SP 500 rose 0.7%, closing approximately 5,886 points. The Nasdaq surged 1.6%, closing in approximately 19,010 points, while the spot gold rose 0.4% to $3,246.95 per ounce. Now, on Thursday, we have US Producer Price Index month on month. Actually, the actual number came out minus 0.5% against the previous 0%. US retail sales month on month also came in 0.1% against previous 1.7%. Now, what does this really mean? Look, the decline in PPI suggests easing of inflationary pressure, which could be translated to a lower consumer prices in the future. However, the slip in retail sales signals a sharp slowdown in consumer spending momentum. As a result, despite the mixed data, the market clearly took the latter as the priority when it comes to the valuation. We were seeing SP 500 index close at 5,569 points, down by 0.4% from the previous day. Dow Jones Industry closed at 41,596 points, declined 0.5%, and Nasdaq Composite Index went down by 0.8%. Now, overall, CPI and the PPI both came in softer than expected, signals the inflation could be slowing down, while consumer seems to be pulling back on the consumption, indicating a cooling economy rather than overheating one. Now, this is a positive outlook for the Fed to begin with. To begin the rate cuts with the equity market can be also beneficial from. Now, another big deal for the last week coming from the US is the US-China trade negotiation update. Now, the United States and China has recently reached a significant trade agreement aimed to de-escalating ongoing tensions between the two nations. Now, both countries have agreed to substantially lower their tariff for the 90-day period. Now, the US will reduce tariff on Chinese imports from 145% to 30%, while China would decrease the tariff on US goods from 125% to 10%. Now, this 90-day period serves as a pause to allow further negotiation towards a more comprehensive trade deal. This was a pleasant surprise for the market, and the market reacted instantly. On the day, SP 500 closed 3.26% higher, Nasdaq up 4.02%, and the Dow Jones up 2.81%. So that's pretty much from me. Now, Ollie, do you have anything to add about this in particular?
Yeah, so I just wanted to add in for last week the preliminary University of Michigan consumer sentiment data, which came out late on Friday. So the print came out at 50.8, which was lower than the 53.1 forecast. This was actually the lowest consumer sentiment reading for the US since June 2022, and it's the second lowest reading ever. So in a nutshell, what this data reflects is the relative level of current and future economic conditions. So with the print coming in significantly lower than expectation, it's suggesting to me that despite the US-China trade deal, investors are still very concerned about the inflationary pressures and long-term dollar strength as a result. It is also worth noting majority of the survey was completed before the 90-day pause was announced. But at the end of the day, a 30% tariff is still a 30% tariff, even if it is lower than what was feared. So I would expect the tariffs to really weigh on the dollar over the coming months, and the same for the US stock market also. But how about yourself, Tony? What do you reckon about the dollar strength going forward?
Yeah, well, look, I absolutely agree with what you just said in there. Ultimately, we're comparing the 2 months ago, we are definitely worse off. The damage is down, that the pressure on the US dollar is still there. So for traders, we believe this is something definitely we need to continuously watching out. So that's pretty much for the last week. Let's move on to this week, what we need to focus on. All right, so on Monday, we have Euro final CPI year on year. Previously, we're looking at 2.2%. The forecast remained the same. So traders who trade Euro USD, you definitely need to pay attention on this news, because the final CPI outcome can have an impact on the Europe Central Bank rate decision, which then in turn will have an impact on the exchange rate. Now, we'll be actually focused on the two scenarios, upside surprise and downside surprise. So for the upside surprise, a higher than expected CPI means more chance for ECB to pause and delaying the rate cuts, leading to Euro USD could potentially rise, whereas downside surprise, it's going to be a lower than expected CPI. That means the ECB might adopt a more aggressive rate cut policy, leading towards Europe USD could potentially be falling. Now, by the same token, on Wednesday, we also have UK CPI year on year. Previously was 2.6%. The forecast has gone up to 3.3%. Now, traders for both forex and equity market should pay attention to these events. Speaking of actually equity market, by the way, as a general rule of thumb, the more likely the central bank to delay the rate cuts or increase the interest rate, the more bearish effect it tends to have on the market, because the business borrowing costs are either remains high or go up, while the rate cuts, on the other hand, is generally considered more bullish. Now, on Tuesday, back home here in Australia, we got a big deal to be announced, the RBA cash rate announcement. Previously, we're looking at 4.1%. The forecasting is to cut 25 points down to 3.85%. Now, the last week's wage price index quarter on quarter came out better than expected. We were looking at 0.9% against previous quarter 0.7%, while the unemployment remained the same as a 4.1%. Now, if you're looking at combining that with core inflation, that has eased to 2.9%, which is within the RBA's 2 to 3% target range, the market is pricing in the rate cut in the next announcement. Theoretically, this will be a positive push for the equity market, while AUD USD could have a bearish outlook. Now, speaking of which, Ollie, what are your thoughts on this?
Well, the market sentiment seems to suggest a 25 basis point rate cut is on the cards. I read a piece by Warren Hogan on the AFR this morning, which suggests currency markets are already pricing in the rate cut, with the Aussie dollar down week on week against the dollar for the last 2 weeks running. NAB, on the other hand, has gone a bit stronger in their predictions, suggesting a 50 basis point rate cut, although I am a little bit skeptical on this one, especially now in the context of the better than expected wage price index reading. I do share the bearish outlook on Aussie dollar prices, though. Right now, it's sitting around the 0.64 mark, so I've got my eye on a sell with a take profit at the 0.615, which actually is a previous support dating back to January 2025. But what do you think, Tony? You also bearish on the Aussie dollar?
Well, that's actually my take as well. So, and for a situation like this, we really need to watch out the surprises, because if everything goes as the market anticipated, it's pretty much a business as usual. But so this is something definitely worth watching out. All right. So now on Thursday this week, by the way, crude oil inventory is another thing that the investors, particularly investors, trading on oil, needs to watch out. Now, previously, we're looking at an announced amount being 3.454 million barrels. Now, the U.S. Energy Information Administration, let's just call it EIA for short. EIA reports that crude oil inventories have risen by approximately 0.3 million barrels per day during the first 4 months of 2025. Now, this is in contrast with earlier expectations of 0.2 million barrels per day decline. Now, this indicating a shift towards oversupply. Now, the thing here is that, look, the accumulation of a crude oil inventory suggests a bearish outlook for the oil price in the near term. Traders are now closely monitoring inventory data and geopolitical developments, as these factors continue to influence the market sentiment and the pricing dynamics. Now, according to Wall Street Journal and Reuters, the unexpected build in inventory has placed downward pressure on oil prices. For example, that the Brent crude decreased by $1.49 to $64.60 per barrel, and U.S. West Texas Intermediate fell by $1.46 to $61.69 per barrel as of 14th of May. Now, the EIA now have adjusted its forecast, projecting the Brent crude to average $62 per barrel in the second half of 2025 and decline to $59 per barrel in 2026. Now, Ollie, I just heard that before that you were talking about something about Russian oil sanction. Did you want to share that with us?
Thanks, Tony. So I wanted to touch on an article I read on Forex Live this morning talking about potential US sanctions on Russia, specifically sanctions targeting Russia's oil and gas refining sectors. So historically, sanctions on Russian oil and refined products will tighten the global supply to put upward pressure on the oil prices. Although in the context of the recent data suggesting oversupply, there's an argument to be made about how much would the sanctions actually move the market. As it stands, there doesn't seem to be a near-term end to the conflict in Ukraine, so I am expecting the sanctions to go ahead and oil prices to go up as a result. Especially if any other nations follow suit, it would put a lot of pressure on the demand for the existing supply and drive the prices up as a result. Given all that, we can see why there's so much uncertainty around the oil prices, but what are your thoughts on that, Tony?
Yeah, I think actually this is definitely a good pickup because impacting on the supply side is more sensitive to the market price than that. So obviously, this is definitely something the traders needs to watch out moving forward. Now, in saying that, since we're there, Ollie, why don't you give us a technical spin on the markets?
Sounds good. Let me just share my screen with everyone. Awesome. So first one I wanted to touch on was the euro pound. So we're looking on the weekly chart. So looking on this chart, I'm seeing a range bound market dating back till 2020. So if we look at the blue line just on here, I've marked the price point at 0.824 as a historically significant support level. So seen on multiple occasions, the price has retested the 0.824 mark and bounced significantly higher. I can see that just here, around here as well, and where we are sitting now. So for where we are now, I can see this trend carrying on. Although with the highs decreasing as well, while the sell-off this particular instance has occurred much sooner than in previous instances. So currently the market's sitting at the 0.84 mark, so not too far off the prices we've seen as support in July 2024. However, I'm expecting the market to carry on in the short-term trend and carry on the short-term trend over the previous month to test that 0.824 mark. Looking on the MACD indicator as well down the bottom, we can see the MACD line and the signal line are trending towards a crossover, indicating a sell momentum heading into the week ahead. So additionally, if we shift this into the daily chart for the euro pound, we can see the MACD indicator, on the MACD indicator, the MACD line currently sits below the signal line, underscoring the bearish momentum indicated on the weekly. So for this market, I'll be looking to sell with a take profit at the 0.824 mark, place a stop at around the 0.85 level as well, just up here, which also acted as a resistance target a couple weeks back, just around here. So for the next market I wanted to touch on was the Canadian dollar against the yen. So starting off on the weekly, similar to the euro pound market, I'm seeing a historically significant price around 102, which has acted as a support price at multiple points over the last couple of years. So in the more recent term, we can see Canadian yen prices have steadily been on the decline, shown by the grey trend line just here, testing the 102 range on multiple occasions to find support. If we shift the Canadian yen into the daily chart as well, we can see that on our Bollinger Bands that the prices have shifted below the moving average, which I am expecting to continue on trend. This is also supported by our MACD average, where the MACD line is about to cross over the signal line, which typically does act as an indicator of bearish momentum. For this market, I'm going to be expecting prices to retest the previous support around the 102. So I'll be looking to sell with a limit at 102 and a stop sitting at 105, which acted as the previous resistance at multiple times this year already. So you can see just here, and around back there as well. So let me just stop sharing the screen there. So that covers everything for the technical section that we've got here. So Tony, did you want to take it away with question one?
Sure, no problem. So the first question is, let me see. What are the risk factors traders need to consider when trading oils? Now, look, the general consensus on the product like oil is that it's more sensitive on the supply side rather than the demand side. This is due to the fact that the demand is relatively inelastic. Okay, in a layman's term, you will need the oil regardless of price going up or down. Hence, the market is less likely to change the demand quantity significantly based on the pricing. Now, as such, the following factors traders need to watch out closely. Number one, geopolitical risks such as supply disruption, sanctions, and trade restrictions. I think Ollie just gave us a very good example earlier, as well as the OPEC Plus decisions. The second thing, ESG considerations. Now, this means growing regulatory and investor pressure on the supply side, as well as any renewable energy development. And the third one will be macroeconomic risks. Currency fluctuations, particular strength of US dollars. This is due to the fact that oil is priced in US dollars, as well as economic slowdowns, which can impact the demand side. That will be from me. You want to go to the next one?
Unreal. All right. Thank you, Tony. So for question two, question is, when are the markets most volatile? So for this one, it can vary based on the market you're trading, but for the purposes of this question, I'll be focusing mostly on FX markets. So typically we'll see the most volatility in the markets around market close and market open, in particular for New York and London. Reason for this is due to lower liquidity in the market, which can also blow out the spreads, as well as markets processing or reacting to market events and releases which happened since the previous day's close. I touched on it just now, but the other times when markets are the most volatile is when there are major data releases which have a print varying from the expectation, such as those we touch on in the last week and this week's section of the call. So the markets tend to price in data expectations prior to an announcement. So any variation on the printed price will move the market. Interest rate changes, data regarding economic strength, such as GDP, unemployment, CPI or PPI, and federal elections are just some of these, among many, many others. It's also worth noting to anyone listening that with the increased volatility also leads to increased risk in the market. So it's worth assessing your own personal risk appetite prior to trading in highly volatile markets to determine if it is suitable for you. All right, so I think that brings us to the end of the video today. A recording of this video will be up on our VIP trading room later this afternoon, as well as published to our YouTube channel. If you haven't visited our VIP trading room, please do. We post a lot of information on there daily and resources as well. Posts coming from myself, Tony, as well as a number of analysts from the Everest Fortune Group. We also have a weekly technical video, which is posted in there, as well as updates on any market moving news or major events. As well, if you are a trader who likes fundamental analysis, please do subscribe to our private client daily update. This is emailed out every morning as well as posted in the VIP chat room. So that's all from me. I'll catch you later, Tony.
Thank you. Have a good one.
You too.